Hello, thank you for joining us tonight. We are just getting started and letting people into the room, coming to you through Zoom and Facebook. So just give us a few minutes to allow participants to join. Thank you. Okay, great. You can see people are coming in. Thank you for joining us. Just waiting for people to come into the room. Give us a couple more minutes. Okay. So it is just past 5 o'clock. So if people are still joining us, they can just come in a little bit late, but I think we will try and get going now that people have started coming into the room. We are coming to you through Zoom and also on Facebook Live. I would like to thank you for joining us. My name is Natalie Pearson and I work at the Sydney Southeast Asia Centre. Thank you for joining us for this SEAC webinar series on economic and social development. Before we get started, I would like to acknowledge the country that I'm calling in from, which is the lands of the Bidjigal people. And I would also like to acknowledge the traditional owners of Australia and recognise their continuing connection to land, water and culture. As I said, I'm on the land of the Bidjigal people, but the Sydney Southeast Asia Centre is located on the lands of the Gadigal people of the Eora Nation. And I'd like to pay my respects to their elders past and present, and further acknowledge the traditional owners of the country on which you may be based and pay respects to their elders past and present as well. So tonight we are joined by my colleague, Dr Russell Toth, who is a senior lecturer in the School of Economics at the University of Sydney. Russell, thank you for joining us. So Russell is a development macroeconomist with his main research interests in the development of the private sector, with occasional overlap with agricultural, behavioural and environmental economics. His research often involves primary data collection, which I imagine has been quite difficult with the travel restrictions during COVID. And his field site focus is in Southeast Asia and the Pacific, including Indonesia, Myanmar, Vietnam and Fiji. Russell holds a PhD in economics from Cornell, and he's going to be talking to us tonight about financial innovation to improve access to finance using evidence from Myanmar. So I'm really looking forward to your talk, Russell. Thank you for joining us. He's going to speak for about 30 minutes, after which we'll have the opportunity for Q&A. So if you have questions arising, just pop them in the Q&A button at the bottom of your screen. And we really look forward to hearing from you, Russell.
Okay, great. Thank you, Natalie. Thank you to SEAC for inviting me. It's really a pleasure to present this research. As you'll see soon, this is research that covers a time period prior to the current situation in Myanmar with the coup in February. So glad to talk maybe about the current situation afterward, but I still hope that this the findings of this study will be relevant both for Myanmar in its future development and also for other countries. I think there's lots of results here. We're looking at an innovative financial product that I think would be relevant in a lot of emerging markets. Okay, so just a couple of preliminaries off the bat. This is based on joint work with Siobhan Herbert, who is an honors student at the University of Sydney. The funding for this study, particularly some of the survey data collection I'll report on, was funded by the Bill and Melinda Gates Foundation through a grant that was administered through the Digital Credit Observatory at the University of California at Berkeley. And I also want to thank my colleagues at Innovations for Poverty Action, who did some amazing work on this to collect data during COVID in late 2020 especially. So, okay, so today I'll be talking about mobile money. Maybe if you tuned in, you already know what that is, so you can take a break for a minute, but I just wanted to briefly review what that is because it's really important for understanding why this financial innovation is important and relevant. So what's mobile money? Well, access to formal payments is low in many developing countries like Myanmar, many other countries at similar levels of GDP per capita. So in countries like Myanmar, often 50% or less of the population have access to a banking account, and all of the formal financial services and payment services that many of us in Australia would be used to through a bank account. And there's many reasons for that, high costs, lack of density of the bank branch network, et cetera. So as one workaround, mobile money has emerged as kind of a light version of traditional banking. So you get access to less services, but there's lower know your customer requirements for the most basic mobile money accounts. They're basically anonymous. The service is accessible directly on a digital mobile wallet that you can access through your mobile phone. And your interaction with the mobile money system is administered through agent bankers. So this would look something like this. In this picture, you'd have individual clients. So they might have some cash that they want to send to someone. They would go into their local mobile money agent, like in their village or neighborhood. The agent can help them convert that cash, physical cash, into e-float, which goes onto their own mobile money wallet on their mobile phone. They could send that money to a different mobile phone somewhere else in the country. For example, the sender could be an urban worker, and they might be sending wages back to a rural area to help their family. So they would send the money through the app onto the receiver's phone. Then the receiver, they're gonna typically be in a cash-based economy, so they're gonna want cash. They can go into their local money agent in their village or a nearby town, and that agent can help them convert the digital money on the phone into cash that they can then spend in the local economy. So mobile money networks don't have like formal bank branches or physical infrastructure. They rely on agents, and agents could be shopkeepers, grocery stores, hairdressers, et cetera. Most mature mobile money networks have tens of thousands of agents. So I'll talk more about our context in a bit, but this is just a graph that shows you what the agents in our data set do. Okay, so typically these agents don't just specialize in mobile money. They typically run a micro, small, or medium enterprise. They might have been doing for many years before they started doing mobile money. In our setting, a plurality report running a convenience store, so about 41%, about 10% run mobile phone retail shops, about 23% report being specialty mobile money agents. And you can see that there's a range of other businesses represented in our data: pharmacies, electronic stores, hotels and restaurants, et cetera. So it's a whole range of people that act as agents, effectively the kind of the mobile money equivalent of a bank. So you get much more dense distribution of access to agents than you would in a banking network. Okay. So the study that I'll be reporting on today is focusing on financial services intervention to enhance the liquidity of mobile money agents. Okay, so if we go back to the previous slide here, we have the agents. They're providing cash in, cash out services. That requires them to have liquidity or cash on hand to be able to process those transactions. And so we're going to focus on evaluating the impacts of a loan product that was designed specifically to enhance the liquidity of mobile money agents, to help them do those transactions a lot more effectively and improve the quality of the mobile money network. So the loan product that we'll be looking at is offered by a commercial bank, which partnered with a mobile money company to provide this access to this loan to their agents. These loans are uncollateralized, okay? They're offered purely based on a simple credit scoring rule that's calculated from agents' previous mobile money volumes. So the mobile money company provides data to the bank on what level of mobile money volumes the agents are processing, and the bank issues the loan purely based on that. They don't do any other credit scoring or subjective in-person credit assessment that would normally be common for these kinds of loans. So I argued earlier that this is a broader interest. I think this is a really interesting value chain lending model that may be of broader interest for lending to SMEs in a range of emerging markets. So the model is that you have an apex company. In that case, it's the mobile money company that's linked to a range of smaller businesses that often have trouble getting access to finance from banks. And so that Apex company has access to some data. In this case, it's data on mobile money volumes, but it could be other data on sales or revenues or purchasing of these small businesses. And the bank can use that data to do decentralized credit scoring and increase access to finance for micro, small, and medium enterprises. So we're going to implement a study that captures the impacts of the loan product on business outcomes. One of the main outcomes we focus on is the loyalty of the agents to the mobile money company. So one reason this financing model might not work is that Apex companies might say, why should I give the bank this data? They're going to lend to my SME partners, and those SMEs might also partner with other Apex companies and give them more business too. So it's going to be interesting to see how getting loans through this specific mobile money company affects the loyalty of the agents to that company. And we'll also look at a lot of results on how that affects their subsequent mobile money volumes. So the idea is this should provide more liquidity. They should process more mobile money transactions after getting these loans. And we'll also look at some broader outcomes for their enterprise, because many are running small businesses beyond mobile money and their household. Okay, so the study took place in Myanmar, former Burma, they're in mainland Southeast Asia. Myanmar has been a rapid adopter of ICT and mobile money in the last decade or so. So after 2011, the Myanmar economy started to open up to the world. And at that time, it was a military-led government that ran a spectrum auction and allowed two international telcos, Ooredoo and Telenor, to launch mobile money networks in late 2014. So mobile phone access has increased massively in Myanmar, from less than 10% when these networks launched to well over 90% within 5 years. And the majority of users are doing so on smartphones, not just simple, like Nokia style feature phones. So after the mobile money networks launched, it's provided an opportunity for mobile money to launch. And so the government created a regulation around mobile money. The current largest mobile money provider launched in 2015. And by 2020, that provider had over 65,000 agents operating in over 90% of townships in Myanmar. And in 2020, they were processing about a little under 12% of the equivalent of Myanmar's GDP in digital payments, so around 10 billion per year, or a little bit less than 10 billion in digital payments. And that number was roughly doubling year on year. So this was really rapid growth over a 5-year period. Okay, so that's the broad context. So with that framework in place, we can think about specific financial products that can be built on these mobile money networks. So in this case, we're looking at a loan product that's designed to enhance the quality of the mobile money network by enhancing the liquidity of mobile money agents. So we leveraged a partnership between a commercial bank and a mobile money company, as I said. I've already kind of talked about this product broadly, the Apex company and the subsidiary kind of relationship. And yes, the loans are offered collateral free, but there were still some incentives for reliable repayment. So for example, if you got a loan and you repaid, then you'd have a chance to get more loans in the future and larger loans. So the loans are basically automatic. Qualification for a loan and the amount depends purely on your prior mobile money volumes, specifically in the best previous month. So this removes all of the typical subjective credit assessment process that would go on. Usually this takes 2 or 3 weeks for a smaller medium enterprise to borrow from a bank in an emerging market. That process could also introduce discrimination, for example, against women or other groups. That's all gone here because it's purely just based on mobile money volumes. The loans are virtually instant. So once the commercial bank confirms that the agent qualifies, they could receive their loan offer within 24 hours. And the loans are remote. So the agents can access their loans fund they can get their loan funds in cash from a branch of the commercial bank, or they could go to any other local mobile money agent in the network. If they have enough cash, they could get the cash from them. So these were relatively, quite large loans. The maximum loan size increased in 2019 from 5 to 10 million Myanmar kyat, so about 3,500 to 10,000 US dollars, or sorry, 3,500 to 7,000 US dollars, so around 10,000 Australian dollars is the maximum loan size. And then after our study period, the maximum loan size doubled again up to 20 million Myanmar kyat. The minimum loan size is about 100,000 Myanmar kyat, so about 70 US dollars at the time. The loans can be 1 to 12 months in length. The borrower can propose that, and the interest rate was capped at the commercial bank lending rate in Myanmar, which is 16% annually. So how did the product do? Our study is going to be based on the first year the loan product was offered, so from November 2018 to November 2019. So as of November 2019, the loan product had reached about 9,500 unique borrowers, so 9,500 unique mobile money agents with over 20,000 loans. The default rate on the loans was less than 1.5%, which is pretty comparable to the default rate in standard microfinance, and is a good low default rate for a small medium enterprise lending product in this kind of setting. The average loan size was about 2.8 million Myanmar kyat, about 1,900 US dollars, and the average loan term that was selected was 3.8 months. So just to give you a reference, as of 2019, Myanmar's GDP and US dollar equivalent was about $1,500. So the average loan size is larger than the average GDP per capita. So these are really substantial loans. It isn't, some of the loans are more like microfinance, but definitely a substantial number are really, small and medium enterprise lending. 49% of the borrowers were women. And this has, obviously been one of the most successful SME lending products in this market. So I'm going to talk about empirical results on what effects we see of these loans. So first, I just want to give one slide to think about what we might expect to see. So we might naively kind of think, okay, more credit, that's going to mean more economic activity across the board. That's certainly possible. So the mobile money agents are not constrained in how they use the loans, formally or informally. The bank and the mobile money company don't tell them how to spend the money. So the loan offers are based on prior mobile money activity, but the borrowers can use the loan funds however they want. So in a relatively underdeveloped financial economy like Myanmar, it's likely that a lot of these agents would be facing credit constraints, that they would have trouble accessing all of the credit they'd like to get, especially at a reasonable price like 16% on the interest rate. So we would expect the loan product to relieve credit constraints, and that on average should lead to increased mobile money processing volumes, increased business and household investment. However, we have seen in some previous studies on the effects of microfinance loans, especially on more experienced business owners. We do sometimes find that that leads to a drop in certain spending like consumption. So sometimes what happens particularly for lower income borrowers, if they're really credit constrained, if they suddenly get access to low cost credit, they say, hey, great, this is a great opportunity to make a new investment. So they might start a new business or expand their existing business, add a new product line. They might migrate or they might tighten the belt to make a larger investment somewhere else. So it's possible, at least in terms of mobile money processing volumes, that for lower income agents in particular, we might see them actually decrease their volumes as a result of getting these loans, which isn't a bad thing. They're probably making their lives better in some other way that they prefer to. So we'll see what actually happens in the data. So the study was designed to try to identify the causal effect of the loan on outcomes. So in general, because agents choose whether to take up the loans and the qualification for the loan is going to be correlated with other characteristics that might drive outcomes, we can't just naively compare loan recipients to non-recipients. So just to give a figure to illustrate this broad idea about impact evaluation. So what we would like is to just compare, so we have outcomes here on the y-axis. We just like to look at non-recipients and recipients and just say that the difference in outcomes, let's say this is some outcome like mobile money volumes or loyalty or income, we'd like to say that this difference in outcomes at end line is the pure effect of the product. But unfortunately, in general, when people are making choices about accepting or offering a product, the impact is, or the difference in outcomes is a mix of the true impact of the loan, or of the product, in this case, the loan product, along with characteristics that drove people to differentially choose to take up the product. So in general, if we just compare recipients to non-recipients of some product, for example, and just look at differences in outcomes afterward, we can't be sure how much we can attribute that difference to the true causal effect of the product and how much is due to differences in characteristics. So to get around that, we want to leverage naturally occurring variations that separate the choice of loan uptake from characteristics. And the results I'll present today will focus on results across the set of all agents. So during our study period, there was a loan policy change that unexpectedly doubled the size of the first loan. Okay, so this happened in May 2019. This was an unexpected policy change by the bank. They saw that the product was going well. They doubled the initial loan offer. So we're going to compare mobile money agents who didn't know that this was coming. We're going to compare agents who borrowed just before this loan policy change and just after. So the ones who borrowed just after were surprised by suddenly being offered twice the amount. But otherwise, we think that these agents are roughly balanced. So they didn't know this was coming. The types of agents who are looking to borrow just before and just after are roughly similar, except the ones who borrow after get double the amount. So all of the results I present will be the effect of doubling that initial loan offer. And for the technicians in the crowd, we also balance our sample on the credit scoring variable. Okay, in terms of data, we rely on two main sources of data. So we have proprietary administrative data that was shared by the commercial bank and the mobile money company. So we have detailed information on the mobile money activity of the agents and the loan data, the loan outcomes. So this is direct administrative data from their internal systems. And then we also did a phone survey that reached about 5,400 mobile money agents in Q4 2020. So this allows us to ask the agents about their broader mobile money activities, enterprise activities, and household outcomes. So a couple of things I want to emphasize. One is that the period we're focusing on is in 2019, and we didn't manage to survey people until about a year after that. So the survey was initially intended for Q2 2020, but if many of you remember what you were doing in Q2 2020, it was a pretty hectic time around the world. So our survey got delayed due to the COVID outbreak. This sample is also not representative of all mobile money agents. We specifically honed in on the agents who are getting loans that are relevant to the variation that we exploit. So like the agents who we see getting loans just before and just after this policy change, we focused on those kinds of agents to have the most data on the agents that are affected by these policy changes. Okay. So just to give you a couple of descriptive statistics, and then I'll jump into the results. So the average mobile money agent in our sample is 37 years old, 72% are married. A huge proportion for Myanmar, 58% have a university degree. The average household size in our sample is 4.7, which is pretty close to the average in Myanmar. On average, our agents have 1.78 relationships with mobile money companies. So there's about 8 or 10 providers in the market. And so there's no exclusivity in the market. Agents could have relationships with multiple mobile money companies. So we'll be able to see, we'll be interested to see how the number of relationships maybe changes as a result of getting loans. The mobile money agent reports working an average of 52 hours per week in the business that's attached to the mobile money activity. So that could be their grocery store, pharmacy, restaurant, whatever. So it's kind of their full-time job. Okay, so I'm going to present results on the effects of loan doubling. I'm going to show you graphs, and these are graphs from what's called a quantile regression. All that does is breaks out the impacts across deciles of the distribution of mobile money volume. So instead of just seeing one estimate for the whole sample, we've got a pretty diverse sample of like lower income, lower volume agents, and probably wealthier, higher volume agents. So we're going to show you the diversity across all of those different types broken up into 10 groups, so by decile. We'll show you the impact on mobile money volumes in month 0. So that's the month where you receive the loan. In the next month, 2 months later, and 3+ months later, to see how the effects intensify or weaken over time. I'll also tell you about the impact of loan doubling on other enterprise and household outcomes. And here's some technicalities for the economists in the audience in terms of controls, et cetera, Windsorizing. Glad to talk about that in the Q&A. Okay, so in terms of main results, this is in result 0. So how do you interpret this graph? So this is a regression in log terms. So on the y-axis, you can interpret the this as a percentage change. So -0.1 means a negative 10% change. -0.2 means a negative 20% change in mobile money volumes in that month. Positive 0.1 is a 10% increase. Positive 0.2 is a 20% increase. And then across the x-axis on the bottom is our 10 groups. So this is dividing up the quantiles. So the agents down here in the 0.1, 0.2 range are the agents who are at the lower end of the mobile money volume distribution. These are probably lower income agents running micro enterprises. And then the agents up here to the right are in the upper right tail of the distribution. So they're probably running larger businesses, larger small and medium enterprises. So what you can see is that at the lower tail, there's actually a negative impact of getting access to this doubled loan size on mobile money volumes, which I hinted might be a possibility for these lower income agents. So it's possible that they get the money and they say, great, I'm going to make an investment somewhere else, for example, and lower their mobile money processing volumes. We have an effect here that's not distinguishable from 0 at this decile. And then it's pretty flat across these upper deciles. We have a positive statistically significant effect of the mobile money volumes in around the range of 10% up till about 15% in these upper ranges. So it looks like a lot of the agents who are running SMEs are taking this money and using the extra liquidity to process more mobile money transactions, where these lower income agents might be spending it on something else. So jumping ahead, this is the effect for 1 month forward. So we see the effects are already much more muted. It's the same kind of qualitative trend of an increase from the lower to the upper, but already for a lot of these agents, here we can't distinguish the effect from 0. In some cases, it might even be slightly negative. Only for the very top decile do we see an effect that might just be slightly distinguishable from 0. This is 2 months later. So interestingly, it looks like the distribution of effects has actually, 2 months later, has actually shifted downward, and there's some negative effects. So that's an interesting fact that we need to explore more, what's happening there. And then finally, 3 months later, things have largely converged towards 0, but it looks like for these agents in the lower deciles, maybe they've switched out of mobile money, at least some of them, or they've switched into something else because they're continuing to do less mobile money processing. In terms of agent loyalty, we see that larger loans on average generate an increase in loyalty. So the average agent had about 1.78 relationships. So if we subtract 1 from that, so that's the relationship that they have with the main company, we see a decrease from about 0.78 to 0.73 in the number of other relationships that they have on average. So about a 20% decrease in their likelihood of having a relationship with another mobile money company, which is associated with a decrease in self-reported income from mobile money activity across all mobile money companies. So this is a significant increase in loyalty to the main mobile money company that maybe refutes some of the concerns that this kind of apex financing model could negatively affect the apex player in this kind of model. In terms of other broader enterprise and household outcomes, honestly, the effects are somewhat muted. That may be partly a function of the fact, again, that we've come together a year later to collect this data. So there's a fairly long recall period. These just reporting on some of the significant effects. We do find a 6.8% decrease in the likelihood that the agent reports struggling with liquidity. We see a slight decrease on average in hours worked in the mobile money related business. So the average was about 52 hours per week. We see about a 4.3 hour decrease per week in that. And we see a slight reduction in investment in the mobile money related business. We see a 4.6% increase in the likelihood of using formal savings. So for some of these agents, they didn't already have a relationship with the bank that they borrowed from. And so getting a loan offer might have prompted them to get a bank account. And so that might be the reason that we see an increase in formal savings. And we also see an uptick in self-reported decision-making power over household loan proceeds on the part of the loan recipient. So this does seem to be slightly empowering, although honestly, we collected quite a few measures of empowerment, and we see near zero effects across a number of other measures. Okay, so just wrapping up, overall, I would say that the kind of the commercial findings here are pretty positive. The loans seem to be an innovative and robust digital lending product based on automated credit scoring with zero collateral that still managed to attain high take-up and low default rates, even for quite substantial loan values. The loans generate sizable impacts on mobile money agents on most agents, although the effects are quite short run. And we see negative effects on volumes for lower volume agents, though maybe that's a good thing. It's providing enhanced access to finance for lower volume agents, and they can redirect their economic activities into something else that makes them better off. Impacts on other outcomes are more muted, though we do see some evidence of increased loyalty to the mobile money company, enhanced liquidity management, formal savings, and empowerment in loan decision-making. Okay, so thanks very much for listening. Those are the main results, and glad to discuss those results further in the Q&A.
Thank you so much, Russell. I might get you to turn off your screen share so that we can see your face rather than your screen. Lovely, thank you. That was great. Lots of economic analysis, which puts me a little bit outside my comfort zone. But we do have some questions coming in through the chat, which I'll come to in a minute. I guess I just wanted to ask you first whether tapping into these loans and this digital finance tool that you've created increases the likelihood that these mobile money agents will start using the formal banking system more. Does it lead to them engaging with more formal institutions, or do they continue with that loyalty to these innovative digital products?
That's a good question. The results that we see on savings seem to suggest that, and I'm sorry, I'm not seeing the button to remove my screen share. So.
Oh no, you've removed it.
I have removed it. Okay, maybe someone else did it for me.
Yeah.
So I would have to speculate a little bit because we didn't look at that comprehensively. It seems that they're saving a little bit more. I would guess that that's probably because some of them are more likely to have a bank account after getting the loan. And more broadly, you know, most of the agents are processing more mobile money volume, at least in the short run. So it, you know, it seems to be that they're continuing to engage with mobile money. So I don't think we're seeing, you know, adverse effects of them switching out or something like that.
Okay. Is it possible that they could continue to use these innovative digital tools and engage in the formal sector more?
Yeah, that's also possible, and there might be complementarities between those two. So, you know, the agents are really kind of like a conduit or an interface between the people in their community, many of whom may not have direct access to the financial system and the formal financial system. So if those agents are becoming more financially aware, they're engaging with banks, and then they're able to bring that knowledge to their clients in their local community who are coming to them for mobile money services. All things equal, that's probably a good thing, and might also, you know, facilitate increased access to the formal financial sector for their clients too. Although we didn't really collect data on that, and to the extent we did, we don't see a lot of that, but that's possible to happen over time.
Yeah, okay, thank you. We do have all of a sudden, lots of questions coming through the Q&A. So I'm going to go straight to those. You did hint at some additional results that you might want to share with us, but I'll see if those questions have been raised in the Q&A first. So the first question is from Tanvir Udin. Thanks, Tanvir, for joining us. In fact, Tanvir's shared a couple of questions. The first one that he asks is, in addition to mobile money transaction data, does the Apex company or the bank look to refine the credit scoring based on actual agent arrears and default performance over time?
Yeah, thanks, Tanvir. Good question. My understanding is pretty much if you default, then you don't get access to the loan again. So they don't incorporate this information in the credit scoring model beyond just saying that you're no longer eligible. Yeah, okay. The credit scoring models continue to to my knowledge, has continued to be based purely on mobile money volumes. Yeah, and then it's just kind of an in or out. If you default, then you're out in the future. So. Okay.
All right, Tanvi, if you want to add on to that, please go ahead and do so. Sandra raises a question that I was quite interested in as well. Sandra Olday, thank you. She thanks you for the interesting study and asks whether you have any thoughts on why the impact on well-being is muted. Is that because there was a 12-month lag, as you said, between collecting the data, or are there any other factors you can attribute that to?
Yeah, that's definitely part of it. We have a lag, and so there was certain welfare outcomes that we didn't really try to measure. I mean, normally if I was doing a study like this, if we were able to do like an experimental study, like a randomized controlled trial, and we were able to say randomize access to loan officers, we could contemporaneously collect data like on consumption and look at that. But in this study, we didn't even try to do that because it was set, you know, it's like if I asked you to remember your consumption, 12 months ago, it was just too far. We did ask some basic measures about food security, the likelihood of, having children going to bed hungry and these kind of things. And we didn't find effects on that front. So yeah, it's possible that, this funding flowed into people's businesses, and that's where we see most of the impact. There may have been short-run consumption impacts, especially for low-income households, but we didn't measure that as much. So,
okay.
Of the study.
I'm going to come to a great question from Isaac. Sorry, Isaac, I can't see your surname, but thanks for joining us. Isaac's question: money is less likely to be used for liquidity by the lowest decile, which gets more and more negative. How do you know how much of this money is used for consumption rather than investment in the lowest decile? There's a second part to the question, but maybe I'll let you answer the first part first, and then we'll come to the second part.
Yeah, those are all getting at questions that things we haven't analyzed yet. So those are really questions. Yeah. So given this heterogeneity and outcomes in the lower deciles, I do want to dig more into that. data. We don't know how, it looks like it's plausible that they're diverting that money to spend on other things that make them better off, but we don't know what that is. So that's something I still need to look at in the data. In terms of the increase in formal savings, yeah, that's a good question.
Well, let me read it out for the people joining us on Facebook.
Sorry. Okay, sorry.
Question. So the second part of Isaac's question was, how is the 4.6% increase in use of formal savings distributed across all deciles, and how high is the default rate in the lowest decile in particular?
Yeah, that's an interesting question. We haven't done quantile regression on that result, so I don't know. But that's I'll make note of that. That's something that we should look at. And I can't remember if we collected data on whether they'd had a banking relationship before getting this loan. So if they did, I should definitely check if this is really, attributable to the savings increase is really about the agents who newly got a bank account because of this loan. And yeah, these are great questions. We haven't looked at the default rate across deciles either, so I don't know the answer to that. That's also a really interesting question that I'm not sure about. So,
but is it something you will be looking at when you dig into the data?
Well, I hadn't thought about it before, but these are really good suggestions. I think we should look at that. Yeah.
Okay, great. Well, thanks to our audience for asking such great
questions.
Thank you. Okay, a few more coming through. From David Levitch, thank you for sharing the study. Did you notice any difference in results by business type? And this might be something you haven't dug into yet. Also, in your interviews, did you find out what new business lines some of the smaller businesses were moving into?
Again, these are good questions that we haven't looked into yet. So we haven't looked at heterogeneity in business type. I mean, given the distribution of business types, we probably can only do that for a couple types of businesses because, some of the categories only had 1 or 2% of respondents in those categories.
Okay.
And in terms of what new business lines smaller businesses were moving into, unfortunately, we didn't ask questions about that. We asked a lot of questions about business investment, and somewhat surprisingly, those effects were pretty muted. So we thought we might see a lot more expenditure on business-related assets, and that was one of the outcomes where we didn't really see any economically or statistically significant effects. So, and we haven't broken this out by quantiles. So again, I don't know what the effect would be like on the lower quantiles.
Okay. Yeah, it comes back to that earlier question. Well, I hope you're taking notes, Russell.
Yes, I am. Yeah.
Okay. Thank you for our great questions. There's a sort of a more conceptual question raised here by Tanvir. There's a lot of criticism of microfinance and its harm. Can you share any further thoughts on whether there were any negative impacts of your research, or was the mechanism of using mobile money agents helping to mitigate some of those risks?
Well, first, I guess what I would say is, separately from this study, the literature, the rigorous literature in economics on microfinance mostly refutes the anecdotes about negative effects of microfinance. So I would say largely the consensus in the economics literature is that microfinance isn't hugely harmful. It's also not hugely beneficial. In terms of our study, we didn't pick up on any notable negative effects. I mean, you could look at some of these results as negative in the sense of people, having, lower income agents having lower mobile money processing volumes. But, I'm going to be more neutral about that kind of result because it could well be that they're choosing to, do less mobile money and switch into some other income earning activity. So yeah, I wouldn't say that there was any results that I'd look at in our study as being, kind of pinpointing an unquestionably negative effect. The last question was the mechanism of using mobile money agents helping to mitigate some of the risks. So this product is focusing on mobile money agents. It's not focusing on lending to kind of microfinance type clients. So most of these agents, you know, if you've kind of selected into being a mobile money agent, you're probably already pretty sophisticated about money. So I'd say that the clients that are targeted by this loan product are less at risk. They're already used to handling money and interacting with the financial system. Mobile money networks could be used in the future in countries like Myanmar to process loans to smaller scale clients. That's already happening in countries like Kenya. So Kenya's got the M-Pesa mobile money network, and there's M-Shwari loans that are quite widespread. And there have been concerns there about consumer protection and people getting access to easy money and that kind of stuff. That kind of lending is you know, a bit less widespread in the Myanmar market. So I think it's a bit too early to say. But the fact that this particular loan product is targeted at more sophisticated agents, I think there's less of a concern about at least financial harm. Yeah.
Okay. Thank you, Russell, for thinking so carefully about your answers. There's one question I just wanted to bring up, which you didn't really go into detail in your formal talk, which was about gender differentiation and results in terms of, you know, male and female borrowers. Could you comment a little bit more on that? What did your results show in terms of gender differentiation?
Sure. If I can share my screen.
Should be able to.
So these are really results. I'm thinking that we'll write a separate paper on the effects of the loans, the gender differentiated effects of the loans. That's more a lot of you answered interesting questions about heterogeneous effects, and I've been really focusing on the male-female since we have this kind of 50-50 split. So this is just showing you the results. So those quantile regression results, this is just breaking it up by male and female. So the blue is male and the red is female. And so you can see that that positive effect that we had on average through the distribution, it's actually for women, there's less of a positive effect in these upper quantiles. So it's possible that women who are running really large businesses that are processing mobile money volumes, let's say that they were more discriminated against in the credit market. They might be more credit constrained than males that are running these larger businesses. And so they might be taking this loan money and spending it on other things than necessarily just processing more mobile money. That's again, this is very kind of fresh, but that's what we're potentially seeing here. So this is the month 0 effect. Then things kind of flatten towards 0 in the next month, 2 months later. And then this is 3 months later. So interestingly, although there's a lot of noise here in the lower decile effect, the negative effect on volumes is mostly concentrated among the men. And you're seeing, at least if we look at the point estimates, that for women, they're actually processing more mobile money volumes later. So things are kind of going in opposite directions across some of these deciles. So there's some interesting effects there that we'll probably explore in a separate paper.
Okay, well, speaking of papers, Isaac has, just coming back to this question of whether microfinance causes harm. Isaac's popped something in the Q&A about a paper that's past peer review focusing on Cambodia, which finds very little positive and mostly negative things to say about microfinance loans in Cambodia. So thank you for sharing that, Isaac. If you're not aware of it, Russell, maybe.
Yeah, I'm not aware of that paper, but I'll have a look at it. I mean, I'm referring to the kind of large literature, you know, based on well-executed randomized control trials on the effects of microfinance around the world. I'd say the consensus in that, you know, that's kind of the most scientifically valid literature that we have on microfinance. doesn't seem to find very significant negative effects, but it's certainly possible in particular contexts that microfinance could be harmful. So not to refute that. So it's, you know, it's certainly possible in this particular context there might be negative effects, but I'm not familiar with this study off the top of my head. So. Yeah.
Excellent. Okay. Well, thank you. It's a big topic across Southeast Asia, of course. So interesting to hear some of the debates around it.
Yeah.
So I'm going to wrap up, but before I do, I just wanted to ask you one last question, which is about the impact of COVID, of course, on your fieldwork and your ability to collect data. Could you share with us, you know, how you're managing that, how it's impacted your research, and you know, what your plans are?
Yeah, I mean, as I said, in this study, I was really lucky to be connected with an organization that had, you know, in-country presence in Myanmar, and we were able to flip and do a phone survey. Actually, to be honest, it's interesting because because of the limited funding in this grant, we had planned to do a phone survey the whole time. So even, you know, back in 2019 when we applied for the grant, and that was quite maybe unique at the time. And then, you know, a year later when we actually did the study, you know, everyone's kind of doing phone surveys. So it was actually a lot less unusual. And my partners in Myanmar really did an amazing job still in pulling that off. I mean, there was definitely some negative effects of COVID on the mobile money sector. A lot of the agents were hard to reach. A lot of agents had shut off their phone and weren't responsive to the survey. So you know, I really give all credit to my colleagues for that.
Russell, can I just jump in there?
Yeah.
Was part of that also related to the political situation in Myanmar, possibly?
Well, that was I mean, that was pre-coup.
Oh, that was pre-coup.
We finished our survey in January 2020, so just before the February, or 2021, sorry. So just before the February 1st.
Wow, okay.
So we were very lucky to finish the phone survey. I'm sure it would have been a lot more disruptive if it had been ongoing since then. I do, you know of some partner organizations that have managed to continue doing phone surveys even since February 1st. So that is a viable research method. But yeah, certainly it's a disruption to visiting the field and developing projects. So. Yeah,
of course. Okay, well, we will wrap it up there. Russell, I'd like to thank you for your time and your generosity in answering some broad questions, but also some quite detailed questions, and appreciate the great questions from our audience as well. So
yeah, thank you.
Thank you once again for contributing to SEAC. You've just frozen right at the end. There you are.
Okay.
You're back.
You probably want me to go back to this.
Yeah, I'll just ask you to share your screen so we can see what's coming up next week. The final in our series on next week, we have Professor Susan Park, who's going to be joining us. She's looking at eco-justice for harm from international development. It'll be the final in our special webinar series on economic and social development. But for now, Russell, thank you so much.
Thank you.
And we look forward to seeing more of your research in the future. Best of luck with it.
Great. Thanks, Natalie.
Thanks, Russell.